the Hedgeless Horseman here. It's February the 3rd, technically here in Sweden. It's still 2nd of February 2026 in North America. Uh, First of all, thanks to the sponsors. I thought this would be, I was gonna make somewhat of a copium video. But I mean, right now the futures are silver futures are up 10%, gold futures are up almost 5%, and yeah. So, but who knows? I mean, it's like we could be red within 24 hours. I mean, that's the problem. I was gonna say with never knowing where the gold price is going. But you can tell obviously that. Uh, I mean, look at these candles. Talk about a whiplash. It's like all the way from here to down here, all the way from down here to up here. So I mean, that was a crazy day. I think it was Friday when that was the worst metal price drop day in ever, or at least in decades, I would think. Um, what does that mean? I don't know. I mean, obviously, it's not like legitimate physical selling where oh, all of a sudden, all the silver in the world is 30% or up to, I think it was down for a while, 35% less valuable. You know what I mean? I mean, that's a ridiculous notion. That's like, oh, compared to Thursday, it's like, yeah, you know what? Silver is actually worth 35% less. No, this is, paper trading and all that. So this is just, well, a paper with the name of silver on it, which is getting more and more honest, I guess, given that there seems to be more actual, physical withdrawal, etc. So it actually is starting to matter, the real stuff underneath. That it's not just a paper called silver that everybody trades like a trading sardine, whereas like the actual physical market, etc., is more starting to run things. Um, that well, this in this case, this is gold, but yeah, silver was even more violent. Uh, and yeah, I mean, I think most of the HODL-folios were down like 4.2 to maybe 5.5% on Friday. I mean, all things considered, if you have the worst crash in one day in precious metals ever, or in at least like, I don't know, 50 years or something, silver, it was probably the absolute worst. And a HODL portfolio goes down around 5%. Isn't that kind of crazy? I mean, I think it goes to my strategy was like I don't try to predict stuff. Okay, why did juniors, for example, or well, miners, I mean the more mature beta plays that are tracking the metal price, they swung a lot, but some juniors were not down much. I mean, it's like I don't know what the average would be, but like some were down 4%, some were down 15%, some were down 17%, but still, I mean, way less leverage than the actual silver price. A lot of them less even so than the gold price. So, I mean, if somebody told you, it's like, hey, how much would you, I don't know, give to just not be a part of the worst metals day in history? I mean, if somebody, just painted that picture, I would think that, well, the portfolio might be down 50% or something. I mean, that is also the beauty of just hodling cheap stuff. Because I mean, is there a reason why a lot of, especially I would say juniors, really didn't crash that much? I mean, yeah, some went down a bit, but it's like I bet you the larger producers might have had a worse, week or last week than a bunch of the juniors. Like why? Because there was not that much hot money, and that's surprising given that like it's much retail in them, and still they did not really crash. I mean, if you just use the metals should be trading or miners should be trading with 3 times leverage to the price of metals. I mean, if silver goes down 35%, basically the miners should be down 95%. Obviously, they were not down 95%, but it's also a case where it's like the higher the metals and silver prices have gone, the less operational leverage the miners had to it. Because as we know, if you have if you have ASIC of $1,200 and gold is $1,300, if that goes up $200, you all of a sudden 3x your margin. Whereas like now, if you add on $200, I don't know what the exact margin increase is, but it's like way less than 3x. So literally, because a lot of people are complaining, that's like, hey, the miners are not moving as as they should if silver price is up 6%. Last week or 2 weeks ago, whatever. But that's the thing. It's like the silver price has been so high and the gold price that the leverage is tapering off. So I mean, if whatever gold is up 3%, maybe the miner should be up 5% or something, which sounds like not a high amount, because usually back in the day, because we haven't seen that many 3% plus days in gold, you would think, well, the juniors are going to be up 10 times, or 10% or 12% or something, and that probably happened, but that was at much lower gold prices, and the beauty of that as well is, of course, that from up here on the downside, there's also less leverage because they have such fat margins still. I mean, if you have ASIC margin of $3,400 and gold goes down $400, yeah, you lost 400 divided by 3,400 in operating margin. I mean, it's not a small amount, but it's like $400 moving gold is a big decrease. But more to the point, like if you own stuff that's cheap. I mean, I made a tweet recently where when you pick gold juniors, like gold is 2,500. I mean, that's why I like to say pick companies like it's a bear market, have the conviction like it's a permanent bull market. So, I mean, if stuff that's not pricing in anywhere near $115 silver or anywhere near 5,000, I mean, gold was up to what? Yeah, $5,600. If they were priced like gold was, whatever, 2,600, that's the price. Like this is in the valuation, this is what the market is saying the gold price is. And gold falls from here to here. It's like, well, that's still super cheap. So it made sense, and that's the beauty of buying cheap. That, I mean, this is almost, I mean, all of this is kind of free upside in a sense. And as long as if gold goes down to 2,500, then you pay the fair price. If it goes below, your previous buy would actually be maybe looking a bit overvalued. But at the same time, if that happens, and I've talked about this before, I think the juniors, etc., would go down, so they would be pricing in maybe $1,800 golds when gold hits 2,500. And by that time, they're still cheap, so they're still a buy. And if that happens, the gold price would have retraced like, what did I say, 2,500? Yeah, more than 50%, and that's very rare. I mean, that's a typical bear market, I would say, for gold probably, or a typical bear market. Let's see here. Yeah, 45%. I mean, then you basically blew past a gold bear, and you're sitting in cheap stuff, and then the next move is probably gonna be higher, so you're gonna make all your money back and then some. So that's when you're, in my opinion, stuck in, and I talked about this in 2023, 2024, where we're kind of past the point of selling, because we know we're getting so close to some kind of bear market bottom, and the juniors were pricing in much lower prices than the metals were at. That is like, well, if I play this through, I'm not gonna reach a point where the hold ever becomes a sell. It's gonna be a perpetual buy all the way to the bottom. So I mean that comes in handy, where it's like, okay, I know why I hold it, because I don't see any realistic scenario where I would need to sell, and if it's cheap, it's an automatic buy, you know. But of course, I mean, look on Twitter. It's like already people are reading into stuff as always. Like, oh, you know, the miners are doing this. Oh, there's a weak action. You know, the fear mongering starts immediately, because let's face it and never forget it. Most people are absolutely not long-term investors. Almost everyone is trying to make sure, or trying to guess what the next short-term move is in whatever asset there is. And typically the ones that have run the highest, let's say, you know, marginal or optionality plays, marginal producers, high cost producers, etc. They're typically the ones that also get kicked in the nuts the hardest when metal prices goes down, because their margins actually shrink the most. Of course, I mean, if you had, let's say, whatever, you know, $5,000 ASIC, and you had a $600 ASIC margin here, all of a sudden you have zero margin. I mean, that's you went from more a better ASIC margin than most miners had during all this period to no margin. I mean, that's going from like really good times to not making any money in a week. I mean, that's obviously huge for, at the moment, for said producer. But I don't try to guess anything. It's like I've said this before. You know, when the revaluation to real is maybe, you know, very late stage, etc., then I would think that crypto is in its current form is practically gone. But when I see, I don't know what Dogecoin's market cap is. It's probably taking quite a bit of hit. But you know, Bitcoin is going down, etc. But this is not wiped out. I mean, a lot of these are, yeah, they're obviously not at their highs, but it's not like, oh yeah, all of a sudden people realize that most crypto, or like crypto overall, is just, you know, or artificial whatever, hot air, I was gonna say, artificial stuff. You don't actually own anything. There's nothing is critical about any of the crypto, really. I mean, it's great code and all that, but it's like there's nothing. And I've said this before. Imagine you had whatever, all the superpowers gathered at a meeting to discuss the future of the world. One country has all the energy, like, you know, fossil fuels, etc. One has all the copper, one has all the food, etc. And one country has all the Bitcoin. I mean, would anybody give a shit what the guy with the Bitcoin? They don't need Bitcoin at all. They have everything the world needs. So I mean, would have absolutely zero leverage. Actually, Bitcoin takes a shit ton of energy, the size of Poland, to actually run the network, but doesn't produce anything then to, you know, make sure whatever that the accounting is correct, etc. But it's like, have you ever seen an economy with only accounting and no economy? No, not really, right? So I mean, hey, I don't know, but when we're close to like, uh, I mean, I think we're on the way to the end game, given how, you know, gold and silver has done. But yeah, I would when the fear of need really takes over, and it's like, you know, really the, what was the saying by Buffett? It's like, it's when the tide runs out, you will see who's been swimming naked. So I don't think we're there yet. I mean, before this is over, who knows? I mean, it's like in 10 years, maybe Bitcoin will really be a thing of the past, and it's trading at whatever sentimental values or money laundering values, way down. So I don't see. I think this is kind of, it fits with this being the start, this being the last gasp of the or artificial bubble stuff. But I don't think we're close to an endpoint. I mean, have you seen a monetary reset? No. Have you seen the debt being, you know, taken care of? No. So I'm not that worried. I think we're gonna have a perpetual bull market, which is not surprising because that's what gold has always done, until there is a real change, until basically the monetary system as we know it has died, and that might be years from now. But that also means then that the bull might be going on for years to come. So it's like, hey, let's, it's always, I mean, we will get sucked into the short term because that's what all of Twitter is basically about. And the latest headline latest headline, what sector is going to be hot, what is looks to be, in store, have a rally in store, for example. I mean, that's it. I mean, the more time you spend on Twitter and the forums, I do believe the more short term you become, because 95% of all content is basically about the short term and how you're gonna flip something for a quick profit, etc., etc. And when I find myself trying to guess the short term, let's put it like this: on Friday, it's like I don't think I might have done like the tiniest of trades or something, but basically I did nothing, almost nothing, in terms of percentage-wise portfolio change. Why? Because everything I owned was still cheap at the new lower gold and silver prices, and most of the gold and silver cases I own, I mean basically all, are centered around the value of the assets being worth more than the market price. And even if gold went from 5,600 down to 4,600, and again their price, like gold might have been 2,500 or something, that's still a huge margin of safety. So I come back, it's like, no, even if they're only down 5% or 10%, and it's like they're still cheap. It's not like gold went down 10% and the gold units went down 40% and they're obviously overreacting. No, I mean, most of them didn't even overreact. And why should they? Because they're not pricing in, and most of them are not even in production, and most of them are not even close to being into production. So what does it matter? But that's a thing to consider, where it's like how you get affected, because everybody, especially on volatile days, then everybody becomes short term. I mean, I think I tweeted that it's like, everybody's a long term investor in a bull market, everybody's a short term trader in a correction. So it's like, I mean, of course I'm gonna have thoughts like, okay, what does this mean for the metals? What does this mean for the mining bull? And then you again hop onto Twitter, and every technical analyst is trying to guess if this, this is going to go lower, or if this is a bottom, etc. Basically, nobody knows. A lot of people say different things, and what conviction does that leave you with? Let's say you read 5 tweets in a row about volumes look bad or whatever, RSI looks bad, or there's no strength in yada yada, and it's like, metals are probably gonna go lower. Okay, how does that make you feel about your miners and gold position, let's say, when you're reading a bunch of people who are guessing that the next short-term move is gonna be down? Do you enjoy the feeling of like, okay, so they're saying I'm gonna have bigger paper losses from the whatever top in the not too distant future? If it already hurt seeing gold go from here to there, and you have 30% corrections in miners, the idea of like, hey, there's probably more paper losses in store when you've already watched 30% of your paper profits evaporate. Does that lead to a good feeling? What does that make you want to do? Of course, that's probably going to make you want to sell. Then you obviously have to snap out of it. It's like, well, what is my strategy? Is my strategy to guess where metals are going, and then also guess where miners would be heading in light of the metal prices, where we've seen gold trade sideways, miners traded down, gold went up a lot, but juniors lagged. So we have ample evidence suggesting that miners are still in a life of their own, especially the juniors, etc. No, okay, so what's my actual strategy? I mean, if you just go back, revert to your regular strategy, where it's like, okay, you picked some case where it's like, hey, I think it's worth this much. It's selling for this price. I bought it here. For a while there, the gold price was up here, and maybe the whatever price went up there, priced in a bit more, then gold went down, and it went like that. Still cheap. And in your idea, it's like, okay, I think it's worth this much. In 2 years, if they execute on their catalyst, or if there's some exploration success that I think will be happening, is gonna happen. In 2 years, I think they will have increased. If we keep a flat gold price, I think their value will have increased to that. And since I bought it pricing in this value, and in the future the value is this much in 2 years, and I mean, if it's a real HODL case, you would just expect this to keep going, meaning the longer you held it from today until that future, you're gonna make more. Well, nothing really changed at all. It's still cheap. The catalysts, the geology doesn't change because of the gold price or the sentiment or any of that. So in your mind, this is how you expect to earn one day. Right? Gold price doesn't change drill results. Gold price doesn't change. I mean, it affects some things like, appetite for ease of financings and stuff. But of course, the better, let's say, team and backers, etc., the less susceptible you are to the volatility of sentiment and the metal prices. So I mean, that's, I guess, one lesson then, that the more of a shitco trading sardine you own, the more you're going to be tied to literal sentiment and literal gold prices. Where a real project that's robust and cheap with ways to increase value doesn't change that much. And like, take a second part of the Lassonde curve case. Let's say, you have a story, I think it's going to be in production in whatever, 3 years, and that these gold prices today, it would be worth this much. But since it's, 3 years away, nobody gives a shit, and that's the opportunity, obviously, because they're going to care more and more the closer you get to rubber meeting the road. And if gold prices are flat, that's the value. If in 3 years gold price is actually whatever up here, then the value of that production coming online might be here. So you have a free option on higher gold prices as well. And maybe gold would need to go down to whatever, 3,300 in 3 years for the value to be down here when it gets online. I mean, if you get a multiple on, if you just calculate a multiple on the free cash flow, for example, well, then, okay, if gold heads down to 3,300, you wait 3 years, they execute, they get into production, maybe this is, whatever, 150% returns over 3 years, which is absolutely great. 150% returns in 3 years. If you could do that forever, you're gonna get rich. There's no other way about it. So that's a pretty good deal. Whereas, like, if they kind of execute, but gold prices go down quite a bit more and stay down to $3,300. If you just wait 3 years, you still expect to get, let's say, 150%. If gold stays where it is, trades flat, maybe your future target is up here, and if gold actually goes higher, we're talking that kind of a Lassonde, second part of the Lassonde curve. Nobody knows what the future of the gold price is, and nobody gives a shit about something that's happening in more than 6 months out, basically, or at least, let's say, 9 months out. I mean, a lot of the junior stuff, that's probably, I mean, even if it's 3 months out, people don't really care. And that's obviously the patience arbitrage. I mean, if you can come up with, and like I touched on, the Gold Sky video I did. I mean, there's plenty of things happening that I see that the market is either totally unaware of, like, nobody really knows much about the Riesberger target, and then, all the catalysts that are, slated for late 2026, Q4, and then, of course, a lot of people would be like, well, why being Gold Sky? Because it's, let's say, some news might be, well, some news might be just, who knows, a day out or weeks out or months, but like MRE, PA, that might be, let's say, 10 months out or 9 months out. Then it's like, oh, why would I care about that? But, well, because it's not priced in yet. And if you can just wait that long, you probably make money just by waiting for an obvious catalyst, simply because nobody gives a shit. I mean, is there an easier edge or more apparent and replicable edge than just having patience to hold when most people can't, because there's always a drill play out there that could move even faster? I mean, it's pretty simple stuff. It's just too boring to actually for most people to do, and that's why you have all this short-term focus. You don't see a lot of tweets like, hey, this case I really like because in 9 months I'm probably gonna be up 50%. I don't remember the last time I saw that. If you could compound your portfolio 50% every 9 months, you would probably be richer than Warren Buffett in 25 years or something. So it's just insane compounding. Why? Because nobody gives a shit. And that's obviously why it exists in the first place. And to be honest, I think I'm very patient, and still I think one of my biggest weaknesses is to stay patient, because I can make a case for almost any junior out there. Any junior that is drilling a target has the potential to make a discovery. So there's a endless bombardment of FOMO out there, and that's being also fueled by everyone that invests on FOMO or short-term stuff, which is 90%. So you have, let's say you have a few hundred or a couple of hundred cases out there which could go up a lot in the short term, and you have most people chasing what could go up the most in the short term. That's a pretty powerful cocktail. So if you can be blind and deaf, you probably do very well. No, it all makes sense, and that's why I honestly, I don't know if I get more out of. I mean, if you are able to pick up interesting idea on X, etc., that's great. I mean, I'm not saying because there's let's say there are some good investors or smart people on Twitter, but it's like most of the stuff. I don't remember almost the last time I actually did a trade or change anything because of X. I think honestly I'm wasting a lot of my time on X, but it's still so interesting because it's we're addicted to the dopamine hits. I mean, there's always you can refresh the X website every second basically, and there's something new that comes up. But hey, I'd rather be doing that than memeing than actually over trading. I mean, one way, and I talked about this before, I mean, I like to, do some lists and just think about, okay, take some, I mean, the most obvious maybe are the cases where it's like the most definite of catalysts in the sense that they have an economic study. They have listed expected ASICs. They have listed expected production profiles. I mean, and then you pick whatever timeline. Then you have an obvious take. AMEX, for example. I think this is pretty up to date. The market cap. This is the latest PA. I don't remember. I think this might be the 12 million exercise. And it's like a stated ASIC. Okay, ASIC margin 350 million US. 350 million US, and if you take that in CAD times 6 for the ASIC margin, and it's like, who knows, I mean, it depends on jurisdiction, longevity of the mine, margins, etc. I mean, what multiple. Silver typically gets even higher multiples, but let's just go with one. Well, then that's an upside of 360%. That's quite easy, because you just take the market cap and then you dilute it by like capex. I just used 25%. Might probably be less than that, especially for AMEX, because they have a bulk sample and debt and all that given the margin, so that should be easier to get. regardless, let's do diluted upside. Okay, 270%, which is absolutely fantastic. The obvious stated, let's say the idea is that, okay, they could be in production in 3 years. Then the thing is like, well, okay, if that's the built-in a sense, the base case, yeah, I mean, that's it, the base case, that they have a project that's good enough to probably be able to get into production. If nothing else happens, let's say, okay, I think I could get a 270% after dilution upside in AMEX if they execute and they're in production in, let's say, 3 years. 3 years for 270% is absolutely great. I mean, what's the odds of the Perron project becoming worthless, for me overpaying? Well, you can play around. It's like, okay, if I account for dilution, I mean, this is not, proper science, but it's like played around with the idea that, okay, what's the margin of safety? It's like, what is priced in now? If you add dilution and it's relative in the sense that, I mean, if gold prices go down a lot, maybe market cap goes down more, so the dilution would go up, whatever, but I think 25 is pretty fair. Well, in a sense, one could say that the current market cap is pricing in a diluted future, where this market cap would be fair if gold was $1,911 per ounce when they get into, let's say, commercial production, assuming the ASIC is correct and the production profile is correct. So if you take 6 times whatever margin that would be at 1911 gold, then the current market cap would be fairly valued. Of course, this is just a crude example. This is not scientific. I don't know exactly what it's going to be. Usually ASICs are a bit higher and there's a ramp up period, yada yada yada. Still, okay, well, I know gold price is for sure as shit not 1911, so at face value this is the margin of safety I have, which is the current gold price, which is 4,861, and I'm paying for a future where they go into production and gold is 1,911. So in theory then, let's say, unless gold goes below $2,000, I'm not gonna really lose any money. That's a pretty fat margin of safety. I mean, that's some of the highest margin of safety this sector has ever seen. That's why these gold units, when I see people are like, oh, that's probably enough of this bull and they're looking to get out. It's like, well, okay, you can do that, but don't come and tell me that you sold because you thought the gold units were expensive. No, you sold because you think gold is going to go down and the share prices are going to go down. Whereas in this example, the gold price would need to go down to $2,000 before you start to, let's say, lose money. Where it's like, okay, 3 years passes, they actually execute, gold is down to 1911, then you're even for that. And that would be a pretty brutal bear market, because that would mean gold went from 5,600 down to 1,911, which, who knows when the last time that happened. I mean, theoretically, I guess, let's say the blow off top here down to this price, 72%, would be something like that. Are we in the same environment? I wouldn't think so. And then, of course, the beauty is if you add some of the, let's say, optionality, or it's like, or catalyst. It's like, okay, it's not, if this is the base case, the production, AMEX also is drilling. So let's say prove up an additional 1 million ounces, something like that. I mean, over 3 years. Whatever. Let's say they expand and infill the other zones, and all of a sudden the apparent value goes up. You could increase the throughput. It would be let's say a bigger, better project. And if it would still be making money down to, let's say, $1,200, it's like they would probably get acquired anyway. If there's like 3 million ounces of low cost gold, for example. So it's like, I can't come up with much better way to stack the odds in your favor, because then assuming there's ample execution, that's why the people is so important, etc. And I like third-party validation. In this case, Eldorado Gold is in. A lot of things need to go pretty wrong for you to lose money, and if things go right, you might get, depending on, anything, there could be whatever take unders, yada yada. Is because all of these are so cheap, so it's like, hey, a case that might be a future 4-bagger or 5-bagger or 6-bagger, depending on the gold prices, might become not even a 2xer. Why? Because they might be bought out before. It's not like, and that's the beauty of the situation for the major miners, of course. It's like, if you're Eldorado, and there's a lot of speculation obviously out there that since Eldorado doubled down and took Sprott's position, now it doesn't cost them that much to buy AMEX. Wouldn't it make sense? If you could buy a 350 million USD margin, and let's say you think you're gonna have 3 million ounces at Perron, and you're paying whatever 457 US. Whatever, add some. The MPV of Perron is, I don't remember what it is. Let's say it's 1.7 billion or something. You're still coming off quite cheap, and if you think that the gold price is going to go up and there's going to be even more ounces, you're getting all that for free as well, and you're getting a discount on just the current deposit with the current gold price, etc. And yeah, you can play around with that stuff, and then do some kind of Kager and have some catalyst, because I try to remind myself of the fact that Pierre Lassonde, what he says about give me optionality and I'll make you a millionaire. I would prefer to get even more. I would prefer to buy something that is tangible value and should be monetized for much cheaper than it is, and then have a bunch of extra free optionalities, like where is Revival Gold? Revival Gold, they have a bonus project. They have literally 2 deposits that looks like they could become mines, and if only their Merkur projects executes and actually turns into whatever 95,000 ounce producer, 1400 ASIC, diluted upside then is 625, assuming 30% dilution. I used 3 years, maybe it's 4. Who cares? That's a whooper of an upside, and that's 94% Kager. Again, very theoretical. But then you have another project which might be almost as good, but maybe less advanced, that you get for free on top of that. Compare that to Revival Gold without it. If they don't do anything with the other project and they're just being valued for the flagship project, then it doesn't really matter, but because the market might not be pricing in the second project even if they have one, but you still get maybe double the value. You know what I mean? There's a reason. If Revival Gold was spun out and you had Revival, Bear Track and Revival Merkur, obviously I think that the market cap would not be 251 million CAD. One might be 200 and the other one might be 150. But combined, you get the other project for free, basically. So as a value investor, that really tips the scale, because you never know. There could be a spin out at any point in time, or if you hold it long enough, maybe they get both projects into production and they are producing 200,000 ounces a year in, let's say, 6 years, and the first project paid for the other project, so it's still only 30% dilution, but you increase this to like 14x or something. Well, this is with dilution, so like 15x. Yeah, that we're talking then a 7-year HODL period, but if you get a 15x over 7 years, yes, I know we're all chasing that every year or every 2 years, but it's like that's don't kid yourself. Most people will never compound like that over the long term. But of course, now a recent rally, we have I don't know how many people out there bragging about their annual returns, etc. And that the thing is, again, note that if you try to get the best returns in the Twitter sphere, you have to gamble. The let's say run very concentrated positions. I'm not saying it can never work out, because I mean, if you really know what you're doing, it might not actually be that risky. But just keep in mind that that's a double-edged sword. You might also have the worst possible uh, return, or it's like, lagging a lot if something goes wrong with those stories, and that might be stuff that you had no idea or could not foreseen. For example, I mean, as you know, averaged down in First Nordic, I mean, basically throughout all 2025, and was First Nordic a great performer in 2025? It was not. It was almost even when the rest of the sector basically ripped. And now, I mean, as of, well, this year, I mean, it's like, what are we, like a month in? The new Gold Sky has been one of the best performers all of a sudden. It's close to multi-year highs. I mean, a lot of stuff is close to multi-year highs, but some juniors and minors have retraced 35% in the last week or so. And Gold Sky has not. So all of a sudden, it went from making the portfolio lag a lot to it outperforming. That's the double-edged sword. The laggers can lag, but if you're right on the case, and you actually average down, maybe you end up making even more on it. So it's like that. The goal is good long-term results. That's the only thing that matters. A single pick doesn't matter. How many percentage points you get from a pick doesn't matter. It's what your long-term portfolio did. You can have a fat position that goes up 50% that's more materially impacting your portfolio than a very, very small position that goes up 1,000%. You get more to brag about, of course, in the 1,000% return, but there might be boring portfolios out there that are only in low-risk cases that will average 50% per year, and they might kick your gambling ass over the long term. And of course, again, the ones that have a lot of the, let's say, marginal producers that have gone up the most, and a lot of shit codes that are flying, like they all of a sudden have a tier 2 project or a tier 3 project where they might have absolute shit and not even close to a mine and incompetent management, etc. Yes, you should be fearing a sentiment dip. You should be fearing a bear market, because they should never have gone up in the first place. They should not have gone up 5x, because they have shit and they are shit. And if we go into a bear market and they have no ways to actually create value or monetize, that's going to show up in the share price one day. Whereas like some of these, let's say better projects with competent, good backing, competent teams, etc. If they just deliver, they might be able to suffer. You might make money even if gold goes down to $2,500 or $3,000, and stay there over the next 3 years. Completely different risk reward in a sense. But if metals keep going up and pigs are flying, yes, a portfolio full of pigs will do even better. I thought we just cover a HODL portfolio here. I don't update this that often, and the idea is because I have like 14 portfolios I manage now or something, which is coloring my way of looking for cases a lot, because I know I can't, I don't do any day trading. I do very little trading, because like, okay, how do I, and that's what I've been talking. My portfolio, for example, is very concentrated in some names, ridiculously concentrated in some names. My biggest position is a private company with an absolutely ridiculous position size. How does that help people? Because it's a private company, it doesn't help a lot. Some deals, for example, that I might get into that everyone can't get into. Should I be heralding them too much? It's like, oh, you should be buying this, etc. Well, my case is very different, because let's say I get full warrants and it's a high risk, high reward case. That changes the risk reward a lot. Because in case of success, if it goes up 5x, I might make 7 or 8x, for example. So I need to be right less often than somebody that doesn't get warrants. And some cases I might not even have even bought the shares unless I got warrants. Because whatever, the risk reward is not there, for example. My point is that I do this HODL portfolio approach not because this is my portfolio. It's because this is only publicly listed stocks that I have for, let's say, family members and friends that I don't expect to need to trade to make money in. They're expected to. I mean, if I came back a year from now and didn't check up on the portfolios, I would expect to be making money. They're kind of, a bit of fire and forget stories. Because again, I do this full time. Most of you, I don't think, do this full time. Do you have the time to have the conviction I have and whatever in individual cases that I might be having? I don't think so. So then it's probably not a civil service in a sense, and it just feels, it wouldn't feel right to. It's like, okay, let's say I'm in whatever. Let's say my portfolio was made up of 20 names, and I get full warrants in everyone. Every single one is a private, placement play, and none of you were able to get into it. For me personally, the only thing, if I would do it for my benefit, I would only be talking about these 20 names, which are the only ones I have this exposure in, and I have even more exposure because I get warrants, etc. So for my benefit, it will make most sense to just talk about those 20, because if I talk about stuff I don't own, it doesn't give me anything if someone buys those up, even though they might be better actual plays in a sense, because you don't need a warrant for the risk reward to be good, etc. So this is as close as I can get to actually maybe at least give some inspiration without just basically talking my book. So I mean, Hemlo Mining is a new one as of January 15. I bought some B2 Gold, looks really cheap. Revival Gold, which I recently talked about. Taseko Mines, I mean, again, it's like my problem in a sense with copper is the fact that yes, I believe the future of copper is very bright. But if you look at gold projects, for example, and silver projects now at these spot metal prices, the copper projects might still have like, whatever, 26-30% IRR, etc. And typically pretty huge capex. NPV divided by capex might just be 3 or something. 3 billion NPV, 1 billion capex. Whereas like you look at the gold projects, they're like, I don't know, 3 billion NPV, 500 million capex, 80% IRR. So it's like, okay, how much do I want to pay for the idea that copper is probably going to go higher when I can buy stuff, let's say gold developers and silver developers, where the prices are already high and they're super cheap to the known information, which is what the metal prices are today. But Taseko Mines is like a multi-mine and a developer, etc. It's like if copper does well, they should do really well, and they have some internal growth. Yeah, so Hemlo Mining, I think it's just a pretty new play. New play, smart people, Canada, old, Hemlo, legendary mine, etc. They have a, district scale land position. They're making good money right now. Yes, I think they're gonna keep making good money. I think they could grow, etc., make it better, yada yada. Am I expecting a 10 bagger in 2 years? No, I'm not. I just expect that it looks cheap. I'm likely, the HODL portfolios are likely gonna make money on them. They can probably afford gold going down as well, and add the alpha from the management team. Magna Mining goes without saying. Exposure to copper, nickel, PGMs, even gold. Superb management team. They're probably just gonna keep growing and executing, even maybe some M&A. Who knows? So this is, I mean, my heaviest bet on nickel, copper, and PGMs, and the biggest asset is still the management teams. Gold Sky, in my opinion, gonna be a tier 1 project, and it's a bit, I guess, misleading here, where it's like, okay, if you just look at, and I use 200,000 ounces of future production in 5 years, and then is with diluted upside, it only comes out to 34% CAGR, which is world class, of course, but still, I mean, might pale compared to whatever some other place here. But caveat being, as I talked about in the video, I think a lot might change. I think this is gonna prove to be more be an obvious, let's say, tier 1 asset or tier 1 gold camp, and that puts it in a totally different category. I think the catalyst alone this year has it at, I mean, if I put a 1 year time frame, I think it could easily go up 100% this year without the help of gold price, just because there's so many heavy catalysts, I think, coming up. So that's just a great, in my opinion, probable returner, aka low risk, high reward. Because again, if I can take probable 100% bets every year with low risk, I would probably only own them. Because like just discussed with, let's say, AMEX, where it's like, oh, the gold price has to go down a lot for you to not make money, etc. And you, even if gold price goes down a lot, maybe they can still do some value creation that it's actually you'll still make money. That's, I mean, all-weather portfolio kind of approach. Margin of safety plus alpha and probable growth and high potential growth. Home Run Resources, this they have a news release out today. That's also been a lagger. I mean, it has done well in kicks and spurts. I mean, I saw a headline today. No, this is not it. That's not it. China solar capacity. I mean, I saw a bunch of headlines where China installed more than twice as much solar capacity in the first half of 2025 as the rest of the world combined. So a lot of solar demand out there. Elon Musk is tweeting about solar. Obviously, as many people know, and I think Shen Lin talked about that, I mean, it takes quite a bit of time and a lot of capex to build a nuclear power plant. Might be, whatever, 10 years and X amount of billions of dollars, whereas like solar power, you could probably just incrementally add that very, very quickly. And now we're seeing, talk about shortages in energy, etc. And you see obviously how the silver price has done, for example. How much is tied to solar, I don't know, but that also is one reason why I think this time is different. I mean, if you look at a 2011 crash to 2015, I mean, did we have 6 years of deficits in a row leading during that bear market? No, we did not. Did we have this solar frenzy? We did not. Did we have as worse of a financial geopolitical landscape today as back then as we have today? No, I don't think so. Did we have a war in Ukraine? No. Did we have the US doing basically coups down in South America and threatening Greenland? No, we did not. So I mean, it's very different fundamentals, I would say, today. So yeah, I mean that's I'm not an expert on silica. I just it seems they have a lot of very high purity silica sources. They come up with news where it's like they have takeoff MOUs for, I think, all of the expected solar glass production, for example, and again with the chips, etc. So to have exceptionally high silica resources, a lot of it, 100 million tons plus. Yes, I think they'll make some money off of that. That's my guess, and we'll add all the verticals. So I simply think I am not an expert on silica, as I just said. I just think that it's a kind of a diversifier, because silica goes into so much stuff like solar panels and like chips, meaning like whatever, GPUs, etc. So I think it's a very interesting angle to play, kind of the high tech and the new energy paradigm, I guess. Don't know if come back in a few years. I'm hoping it's gonna be up a few multiples. I just have a hard time seeing that they're not gonna be able to make some money on their resources. And I mean, they've stated a lot of MOUs, etc. And it seems that exceptionally high purity silica is quite rare. Integra Resources, pretty simple stuff, making money now on the Florida Canyon. They have 2 even better projects in the pipeline, and since they have 3 assets, you're absolutely not paying full price for all 3. So a lot of just, a lot of discounted sleeper value in a sense that I think is going to matter one day. So just imagine they have 2 mines up and running in a few years, and then a few years after that they have 5 mines up and running. If they execute on that, yes, I think Integra will be up a few multiples. That's good enough for me. It's more execution risk, I guess, than anything else. But it's like not an exploration story. It's just if they execute on the development side, there should be some a built-in multi-bagger, and the biggest way to take advantage of that is just time until the sleeper value gets monetized. AMEX exploration already talked about. Hemlo already talked about. Goliath Resources. Yeah, I mean it's a aggressive exploration story in BC, Canada. The more they drill, the bigger it's gonna get, I think. Simple as that. They don't have any resources out yet, because they do it, I guess, the newfound gold kind of route, and I would think that they're gonna be bought out one day. Montage Gold, biggest asset management team and backers, Lundins and the ex-Endeavor Gold team. If you just look at whatever Montage at, let's see here, I think I just assume they're gonna hit 400,000 ounces of production. Let's say give that 1.5 years at today's gold price. Slap on I think I used a 6 times multiple on that. Did I? Yeah, still 6, even though they might get since it's kind of a Lundin company, might get more than that. But it's like, hey, if they produce 400,000 ounces in 1.5 years, 1,200 ASIC, that's actually higher than the feasibility study, I think. Anyway, ASIC margin of $1.36 billion US. 6 times that is 11.15 billion CAD. And that's 133% higher than the current market cap in CAD. And then they also bought Africa Gold. So by the time this is in full-scale production, assuming this happens, I would hope that it's going to be up 133%. 133% in 1.5 years. That is a great compounding for what I would say a kind of low-risk play. I mean, the risk, I guess, is Africa, Cote d'Ivoire. But then by that time they have probably on their way to putting their maybe not in production, but maybe feasibility study, etc., on their second project that they just acquired. And given the amount of alpha, they might have done discoveries along that time. They might have made another M&A along that time. So that's what I love about. I mean, it's kind of the magna mining of gold in a sense, where it's like you're starting at any point in time. You have like expected catalysts going forward, but they have so much alpha and let's say an aggressive team that there's going to be catalysts and future second part of the Lassonde curves or discoveries, etc., that don't show up in the presentation anymore. So it's just going to keep extending kind of the I mean, if you have the known catalysts within the next 1 to 3 years, well, when they might have paid off, you probably have new catalysts for the next 1 to 3 years. So you just kind of keep being able to possibly HODL them, because a lot of it will still be that, well, okay, let's say in 1.5 years they're up 133%, but by that time they might have another mine, the African gold mine, that might be construction might be starting in not the too distant future, perhaps. And let's say they can do 200,000 ounces. That's 50% growth all of a sudden. So it's like when this has paid off, you have a new thing to wait for. That 2 years later, you should at least be up 50% more, and by that time they might have made more discoveries and more M&A, etc., etc. That's great stuff. Sierra Madre Gold and Silver. Again, there's not that many silver juniors I actually like. A lot of the silver juniors I think have crap projects or are super early stage, but now they're springing up all over the place. All the silver juniors where they have a rock sample or they have some tiny resource, and all of a sudden they have, whatever, 50 million market cap, etc. I mean, not exactly the lithium days, but starting to almost smell like it. But Sierra Madre Gold and Silver, a lot of insider ownership, good backing, multi-asset, aggressive exploration plus development, so production growth plus exploration growth. A lot of skin in the game, experienced miners working projects they've worked before, so it's like they have a lot of risk. They're not going to do anything stupid, I don't think. So it's like, hey, in 2 years they might look very different than today, for example. So it's like, why do I need to bet on these crappy shitco silvers when you have Sierra Madre, for example, which is probably better at executing and knowing what value is than 90% of other silver gems. BlackRock Silver, very high grade stuff in Nevada of all places. I mean, their ASIC in the PA, it's like what was it, $12 US or something. When do you start to fear about a project like that? It's like, oh, silver's down to $82, and let's say they have a $12 ASIC. Even if it's $20 ASIC, they were making a shit ton of money if that project, if they execute and that delivers somewhat close to the PA study. No, that looks like an all-weather project basically, where it's like it's very high margin. It's in Nevada, tier 1 jurisdiction. Hopefully tier 1 costs, all of that. Is that a guarantee? No, but if they execute on that could become a very big mine. I mean, I think the last I calculated, I think the AG equivalent ounces is like 10 million ounces a year or something. I think that's more than Avino produces. Maybe not in AU equivalent. No, AG equivalent if you include the base metals. I'm not 100% sure, but it's like that's a pretty beefy production profile. And Avino is at, I think, 2.4 billion or something. BlackRock is not at 2.4 billion, and they're in Nevada. And that's what was interesting. Again, going back to the quality of the stuff and having an all-weather approach. Is BlackRock Silver the lowest market cap silver developer out there? No. But on the day when silver went down 34% and closed down, I think 30 maybe, I think BlackRock ended down 4%. Which is, again, the beauty of it. It's like it's $115 silver, $110 or whatever you start. I mean, it's so, the potential margins are so obscene that you can still cut away 30% of the silver price, and that would be still hopefully a very high margin operation. And it was not even close to pricing in that, yes, silver is going to be $150 when they go into production, and they're going to be producing 10 million ounces of AG equivalent, and they're going to be, I don't know, having their current market cap in free cash flow, basically. Southern Cross, Darren Morecambe, who's the main, I would call him, I think, main sponsor nowadays of Gold Sky Resources. So they hit a phenomenal hole recently. That's not lowly valued, but that looks like a tier 1 project as well, and it's already up to 3 billion almost, 2.7 billion I think, and they don't have a resource out yet. So that's what I kind of foresee happening for Gold Sky, for example. That it, and they already have a resource, and they will do a PEA as well. That it's going to be acknowledged as hopefully a tier 1 camp, and then it's going to take on a life of its own, for example. Uh, and I mean, in production, if Mawson, I don't know what the production profile, etc., would be, but if that's a, let's say, basically a tier 1 project going into production, even this 2.7 billion market cap is going to look cheap, I think. District metals, that's my go-to, in a sense, uranium bet. Sure, it's a lot of it is tied to Sweden, but of course, but it's just a mega bet on uranium and a bunch of other metals and minerals. So it's not just uranium; it's a bunch of very low grades, though, but a bunch of other, like nickel, zinc. I don't remember all the elements even in it, and they have many projects, etc. So it's like, hey, if you want to secure a bunch of critical minerals, maybe the Alum shales have 8 of them or something, plus uranium, plus the world's biggest or second biggest uranium deposit. And the Nordics are talking about nukes again. So it's like, the funny thing is that it was the Alum shales at Ranstad which were mined to produce uranium for the Swedish nuclear project. So yeah, they've even used that stuff to develop nuclear warheads or nuclear bombs. Yeah, got some Lundin people in, Garrett Ainsworth, which I think is an absolute stellar CEO. They have the base metal projects as well. Inflection Resources, this would be still the earliest stage of all the actual, top 15 positions. Simply because they own a goddamn empire. That's it. So far, haven't made that bullseye discovery hole. Don't know when it's gonna happen. Don't know if it's gonna happen. But hey, they have extremely large real estate in Australia looking for giant copper systems, primarily copper gold systems. If one of those pay off, boom, that's gonna be probably a quite enjoyable ride, and you have the optionality. It might not be just one; it might be even more than that. Don't know when it's gonna pay out or pay off. Maybe they make a discovery in 2 years, and it's up 10x, and then if they make a proper discovery, it's gonna go up much more than 10x. But yeah, let's say it's up 20x in 2 years. Might not ever be up, or they might never make a discovery, but they will keep finding projects that are a huge skin in the game. So this is a story I think one could HODL for many years and basically forget about it, because the management team, full of some of the smartest people on this earth when it comes to exploration, will be constantly obsessing about it. And then I guess when a discovery happens, an example, let's say it takes 2 years and they make a real discovery and it's up 20x, then you go back, it's like, okay, I made 20x on a whatever 5-6 years HODL even. It's like, that's a pretty good return, because that's usually what how long it takes to do a 20x. That's years, not 1 year. Snowline Gold, I have started to take more and more profits on that one. That might probably be one that's kind of close to maybe getting out of the top 15. This is an absolute world-class deposit, as everyone basically knows. And absolute huge land package. They might end up making more discoveries. I think they're gonna be bought sooner or later. Don't know if they sell just the Valley Gold deposit, but but it's just one of those things where it's like, yes, it's a absolute tier 1 deposit. But okay, what are the big, in a sense, risks? Well, the permitting, etc., is probably going to be a long slog, and the capex is not going to be really, really small. And funnily enough, what is kind of fun is that at these gold prices, the value deposit is so good that it's almost wasted in a sense. Because let's say you have a really good mine that has an ASIC of $1,200, and then you have Snowline at 800 ASIC. So that's a $400 difference. But at $5,000 gold, that's not that much of a difference all of a sudden. And then you add the timeline, to development and all that. So, what am I saying? I'm not saying Snowline is overvalued or expensive. I mean, they would absolutely piss money if that was in production at lower gold prices as well. Behemoth type deposit. I mean, a company making deposit. It's just that, yes, it's still not risk free. That might be in production in 10 years. We don't know. Can I find something that's pretty cheap and might be in production in 3 years or something? At these gold prices, when the quality of the low cost ounces at Snowline, when the difference is not that huge simply because the gold price is so high, that's a pretty okay deal, actually, I think. But yeah, if that was up and running, I don't know, $10 billion easily at these gold prices. I mean, probably more than that, because I don't know how much money they will make a year. Let's say 1,000. I'm just gonna do a test here. Let's say, I mean, the first year probably 500,000 ounces of production or something. Let's say the gold price is $5,000 minus 1,000 ASIC, 4,000 times 500, got them 1,000 ounces a year. Okay, not my calculator couldn't even do that. But what is that? 20 billion? No, 20 billion. 2 billion, right? Man, it's like I've become so bad at math all of a sudden. What did I say? 4? Yeah, $2 billion. Yeah, I mean that'd be easy. So $2 billion ASIC margin per year. It's like, what's that gonna be trading at? A lot. I mean, 5x that is 10 billion, and this is USD. Those won't be net profits, but I don't know. It might be trading at 15 billion, 20 billion or something. So I mean, is there upside in Snowland? Absolutely. Absolutely. It's just that, okay, when the rubber meets the road, I don't know when that's gonna be. Because I mean, Snowland could be a goddamn 10 bagger from here, even, especially if, let's say, they have advanced the project, 5 years from now, and the gold price is at $7,000, and Snowline is selling for $12 billion, because now all of a sudden, things are starting to line up where it's like, this is probably gonna be in production within 3 years from then. Yeah, so I think there could be a multi-bagger in Snowland yet. It's just that I would also think that some maybe majors see it as somewhat risky, because like they don't. It's not a guarantee that they're gonna be in production, in this cycle. For sure, that's not a guarantee. Altamira Gold, that's one of the recent laggards. That is, yeah, I just think it's cheap. I mean, I'm hoping there's going to be a good pickup in news one of these days, because again, like they have near surface gold with very good metallurgy in a very good place in Brazil. They have X amount of targets. With that said, uh, they have been relatively conservative with the drillings. I mean, they have a district play, could have a lot of drills, but I think, yeah, I think they're being quite conservative, etc. I hope this turns into I hope this year it turns into a development plus exploration story, where it's like it's obvious that whatever they're gonna try to get into small scale production, because that looks like super easy stuff to do, kind of like a Cabral, where you have a near term production scenario with gold prices at record levels, where even 20,000 ounces of production at $1,500 ASIC would make a shit ton of money, and it could basically multi-bag just based on that. And then you have the fact that they have like, let's say, closer to 2 million ounces, and it could be much more than that. Osisko Development, I was kind of surprised they actually did a raise. I have also been expecting more news flow on the development front, which is kind of surprising. That's not been more stuff on that. The big picture idea is that, okay, they have multi-million ounce gold system. It could be an absolutely, let's say it could be a super major kind of system. So yeah, I like the idea of, let's say, they are able to get into production, and let's say they do produce some 200,000 ounces, and in 5 years they're producing 400,000 ounces, and by that time they have 10 million ounces on the books or something, and it's obvious that they have even more than that. Well, that would be a world beater operation if they execute on that. So that would be, yeah, I don't know, 10 billion plus easily in that scenario, maybe $20 billion. So yeah, that's one. But again, listen to the timelines. And that's the beauty of it, I think, or to have a last point on just being a long term. If you ask me, if my time horizon was 1 month, I have no idea if I would even own any of these companies, because in 1 month I have absolutely no idea where these are going to trade. But some are like open-ended. Obviously Magna Mining has catalysts, etc., with their projects, and ramp up of production, etc. That's a given. But also the idea behind, especially maybe Magna, Montage, and kind of Gold Sky as well, is like, I think there's so much probable growth that the simple formula is going to be, the longer I hold them, the more I'm going to be up. And then you have some more, like, I guess, simple cases, or yeah, in a sense, where it's like, well, Integra, you're looking at the scenarios, like, I could not make a case for Integra where it's like, if somebody asked me, hey, I want to make money this month, should I be in Integra? I have no idea. Integra could be down this month. Gold could go down $500 more. But if I make the case where it's like, let's say for Delamore is in production in a few years, should I have made money then starting at today's gold price? I think so, right? Because that would be 3xing their production profile. That's a pretty simple case. So I can make it when there's, or it's like the no-brainers show up over time. And the only way to capture them is time held, basically. That you HODL from the price and reality today, or narrative today, to some catalyst that you preferably would know in the future. If I hold it from now to then, which few will, even if they know it, they can't wait for it. if you pitch someone a store, it's like, hey, they're gonna have a news release out in 9 months, and it's gonna show that this project is worth 100% more. Again, I swear, it's like most people, vast majority of people would not give a shit about a case like that. And the few that actually do and are able to suffer potential boredom for 9 months, they might be up 100%. Even if it takes 2 years, that's 42.4%, I think, per year, which will become your portfolio will be compound. If you can compound like that, that is absolute world class. But nobody gives a shit about that. The people who can't compound at 42% per year, they're obsessed by finding stuff that's going to return much better than that. And therein lies the irony. That the ones who are trying to get the absolute best returns are typically the ones that, in the end, are going to have the worst returns. I know some people who just HODL basically Lundin stories. They've killed it over the last 5 years. Absolutely killed it. And still those charts are 95% of the time are boring because they're not making new all-time highs. Anyway, I think that's it. I had a bunch of other companies I was going to touch on with some news, etc. But this is already up to 2 hours long, of course. And I thought this would be like a 20-minute intro in a sense. And then go into some news items. Anyway, consider me biased. Assume I own shares of all companies mentioned. Some might be banner sponsors as well. In that case, twice biased. But I would just want to leave you, and do your own due diligence. Don't invest money you cannot afford to lose, etc. I would just remind myself every day, all day, about why you own every single, company in your portfolio. Is it centered because where you think gold is going to be trading next month, next week, tomorrow, 12 hours from now, or is it centered around, well, if they, execute on some catalyst, I think the value of the companies are going to go up quite a bit, and they might already be cheap. So even if gold went nowhere, even if gold went down, it's going to be hard to have. I mean, again, the simplest way would be like, hey, take Integra for example. It's like, in 3 years, Integra is producing 200,000 ounces of gold or gold equivalent. Is that gonna be trading at whatever the market cap is now, if gold is even close to where it is and the ASIC is? I mean, yes, the Florida Canyon might be quite high still, but let's say, drop that to 2,000 ASIC and have Delamar at like 1,400 ASIC. Is that gonna trade for whatever it is, 900 million CAD? If they're making whatever the ASIC margin would be in the US, and by that time Nevada North might be somewhat close to production, and hopefully they would have expanded Florida Canyon by with a few years of extra mine life. No, I don't think so. So that's a case one can make, that I should be up in 3 years. Within summer from now to 3 years, I should be up, let's say 200%. That I can make a simple case for. I cannot make a case for what Integra might do in the next month, 2 months, 3 months even. I don't know what gold price is gonna do, etc., etc. As long as the risks are to the upside in in some time frame, that's how I make a case. Some cases might be I mean, First Nordic, given all the catalysts that should be very impactful this year, I have, an internal case of, Gold Sky. I have an internal case of Gold Sky just for this year to start off with. That I think this year has a high likelihood of being very rewarding. Magna mining a bit more open-ended, where it's like the longer I hold it, I think it's just gonna be more rewarding in a sense. Home run resources, somewhat of us like, I don't know when everything is gonna pan out, if it's gonna pan out, but I can see different scenarios where it's like if I come back in 2 years from, because now it's not pricing in that they will have any really meaningful business at all, whereas like I think they could have a very meaningful business, but the only way to find out is to hold until they might have a meaningful business. And then if I look at the delta between a time, let's say today, when they're not priced like they will have a meaningful business, to the point where they have a meaningful business, yes, that's how I would be making money. Integra already talked about. I mean, a bunch of the other ones are, Magna, Montage I talked about, etc. So some are just kind of more like open-ended in a sense, where it's like I don't have one obvious catalyst even. I just think that whatever. I mean, the best ones is where like the management team is so good that you don't even need to, one way or another they're gonna figure out how to give good returns. I mean, I actually think British Metals is a good example of this, where it's like it started off as a base metal play in the Bergslagen area of Sweden. Then we had some shitty years. Nobody gave a shit about zinc and polymetallic deposits. Pivoted to uranium, and Gert obviously has a lot of experience with uranium. All of a sudden, it became one of the best performers in 2025, etc. Got some Lundin people involved. I mean, that's really how he found a way basically to win for the company and for the shareholders. So when you have people like that, you don't really need to worry. Then it kind of becomes like a Magna mining montage kind of situation where these guys will be obsessing about how they create value for you every day, 24/7. And then you just come back one day and you don't even need to know exactly what they had in store, what ideas they have. You will see that they probably have just executed, and therefore the company is higher value, then the share price is up. It's like, take the Lundin company. I mean, you don't even take a Lundin company, let's say a fresh one. Do you even need to know anything about the projects? Really? I mean, let's say you see, new Lundin Junior has formed in whatever copper somewhere, and they put in $50 million. It's like, do you even need to read a presentation to figure out that, hey, these guys are probably gonna make it be more valuable in a year or two? No, I honestly don't think so. But it's so stupidly simple, and like, that it's amazing. I mean, most people out there, they totally undervalue people, and I did for a long time as well. Anyway, enough of that. Thanks for listening. Don't invest money you cannot afford to lose, and honestly, if you are too anxious about a position, it means that you probably should diversify a bit. Diversify just until you are kind of bored, I would say, and then you don't need to watch any position like a Hawkeye, and every single one is like, I mean, it would be great if you just found a bunch of relatively low risk no brainers, where it's like, okay, they have 1, 2 to 3 year timelines where they're probably gonna be up 100 to 300%. That's it. That's great. If you do that and if it works, you're probably gonna outperform 90% of people anyway, just from absolutely doing nothing except have a year to multi-year time frame and figure out what the company might look like by that time, and then compare it to what the market is pricing it at today. Yeah, thanks for listening. Bye.